Property management is one of real estate's quietest businesses. But here's what makes it so powerful. A management company can earn money from a property without ever owning it. They don't buy land. They don't take on a mortgage. They don't risk their own capital on a building's value. Instead, they get paid to run someone else's asset. So, how does this entire business actually work? Let's follow the money from the first phone call to the monthly payout. Every property management relationship starts with an owner who doesn't want to or can't run the property themselves. Maybe they live in another city. Maybe they own too many units to manage alone. Maybe they simply don't want the phone calls at midnight. That gap between owning and operating is where property management companies live. The bigger that gap, the more valuable the service becomes. Before any money changes hands, the owner and the company sign a management agreement. This contract sets the terms, what the company is responsible for, what it can charge, and how long the relationship lasts. A poorly negotiated agreement can trap a company into doing expensive work for too little pay. A well-structured one builds in fees for nearly everything the company touches. That's why experienced management companies treat the contract itself as the first and most important deal they make. The core of the business is the management fee. This is typically a percentage of collected rent, often somewhere between 8 and 12%, charged every single month. It sounds small on one unit, but multiply that fee across dozens or hundreds of doors and it becomes a steady, recurring revenue stream. The company doesn't need the property to appreciate. It doesn't need a sale. It just needs rent to keep coming in. That single detail changes everything about the incentive structure. Because the fee is based on collected rent, not on the property's value, the management company's income rises and falls with occupancy and payment performance. A building sitting empty generates nothing for the manager, even if the manager isn't the one losing equity. This is why keeping units filled and rent flowing becomes the company's central obsession. Filling a vacant unit is its own business inside the business. When a tenant moves out, the property manager doesn't just wait for a new one to appear. They market the listing, screen applicants, and coordinate showings. For this, they usually charge a separate leasing fee, often equal to 1 month's rent or a flat percentage of the annual lease value. This fee exists because finding and placing a tenant takes real work, and it's work the owner would otherwise have to do themselves, but leasing fees create a subtle tension. A company paid to fill vacancies quickly has an incentive to fill them fast, sometimes faster than it should. Placing a weak tenant to collect the leasing fee can backfire later through missed rent or an eviction. That's why the best property managers balance speed with screening discipline. Moving too fast protects this month's fee but risks next year's income. Once a tenant is in place, the relationship doesn't end. Leases eventually expire and someone has to negotiate the renewal. Many property management companies charge a renewal fee, smaller than the original leasing fee but still meaningful, for retaining an existing tenant instead of finding a new one. This fee rewards the thing owners actually want: stability. A tenant who stays for years is cheaper for everyone than one who leaves after 12 months. Rent collection sounds simple, but it's a business function on its own. Every month, the company has to track who paid, chase down who didn't, and move funds to the owner. When rent arrives late, many management agreements allow the company to charge a late fee, sometimes shared with the owner, sometimes kept in part by the manager. This turns a tenant's mistake into a small revenue line, though a responsible company treats it as a deterrent first and income second. Maintenance is where property management gets complicated. Roofs leak, appliances fail, pipes burst at inconvenient hours. The manager has to coordinate repairs, dispatch vendors, and keep the building functional. Many companies charge a maintenance coordination fee or a small markup on repair invoices, often 10 to 20%, for managing this process. It's compensation for the phone calls, the scheduling, and the oversight that keeps a small problem from becoming an expensive one. That maintenance markup, though, is a delicate balance. Charge too much, and owners start to feel like every repair is being used to pad the bill. Charge too little, and the company loses money every time something breaks. The companies that last build trusted vendor relationships, negotiate lower contractor rates, and pass some of those savings back to the owner. Efficient maintenance protects the fee income and the client relationship at the same time. Move-in and move-out inspections generate their own small fees in many portfolios. Documenting a unit's condition before and after a tenancy protects everyone involved, the owner from damage disputes and the tenant from unfair deposit deductions. Property managers often charge a flat inspection fee for this service. It's not a large number individually, but across hundreds of units turning over each year. It adds up into a meaningful revenue category when a tenant stops paying and refuses to leave. Eviction becomes necessary, and it becomes expensive. Legal filings, court appearances, and lockout coordination all take time and expertise. Many management companies charge a separate eviction fee, sometimes flat, sometimes tied to hours worked, because this process falls entirely outside normal monthly operations. It exists precisely because things occasionally go wrong, and someone has to be paid to fix them. Screening applicants is another quiet fee source. Running background checks, credit reports, and income verification protects the owner from a bad tenant placement. These costs are usually passed directly to the applicant as an application fee, and in many markets, the management company keeps some or all of that money. It's a rare case where the person paying isn't the client at all, but someone hoping to become one. Beyond individual transactions, many management companies now sell add-on programs that create recurring income without any extra labor. Tenant liability insurance requirements, resident benefit packages, and portal subscription fees can all generate monthly revenue per unit. These programs often cost the company almost nothing to maintain once set up, which makes them some of the highest margin income in the entire business. Technology has quietly reshaped how this money moves. Modern management companies run on software platforms that handle rent collection, maintenance requests, and owner reporting automatically. This reduces labor costs per unit and allows one manager to oversee far more properties than they could with spreadsheets and phone calls. But the software itself costs money every month, and a company that underinvests in it can find itself outcompeted by more efficient rivals. Scale is where property management becomes genuinely profitable. Managing 10 units barely covers overhead. Managing 1,000 transforms the business entirely. Fixed costs like office space, accounting staff, and software licenses get spread across far more revenue-generating doors. This is why growth-focused management companies chase portfolio size aggressively, sometimes accepting thinner margins early just to build the door count that eventually makes the business efficient. Owner retention matters just as much as door count. Every client who leaves takes their recurring fee with them, and replacing that revenue requires new sales effort. Management companies that communicate clearly, report transparently, and control costs tend to keep owners far longer than those who don't. Because so much of this business is built on monthly, repeatable fees. Churn is quietly one of its biggest financial threats. Some management companies expand beyond single rental homes into commercial buildings, apartment complexes, or homeowners associations. Each of these brings a different fee structure. Commercial management often includes fees for negotiating leases and coordinating tenant improvements. HOA management usually charges a flat monthly fee per community rather than a percentage of rent. Diversifying across these categories can stabilize income, since a slowdown in one sector doesn't necessarily hit every revenue stream at once. Growth in this industry increasingly comes through acquisition rather than organic client building. Larger firms buy smaller local management companies to absorb their existing portfolios instantly. This consolidation trend lets a company add hundreds of doors overnight instead of winning them one contract at a time. But integrating a new company's staff, software, and client relationships isn't automatic, and a rushed acquisition can lose clients faster than it gained them. Private equity has taken notice of this dynamic too. increasingly buying up regional management firms to build national platforms, betting that recurring fee income across thousands of doors is worth far more combined than it is scattered across dozens of small, independent companies. Risk in property management doesn't come from owning the wrong asset. It comes from mismanaging someone else's. A missed maintenance issue, a fair housing violation, or a mishandled security deposit can trigger lawsuits, fines, or the loss of a client relationship overnight. Because the company's reputation is its main product, a single serious mistake can undo years of steady fee income. This is why the most successful firms invest heavily in training, compliance, and documentation long before problems appear. There's also a structural threat sitting underneath the entire industry. Self-management apps and do-it-yourself tools now let smaller owners handle rent collection and tenant communication without hiring anyone. This puts pressure on management companies to prove their value goes beyond simple administrative tasks. The firms that survive this pressure tend to be the ones who lean into judgment, relationships, and problem-solving. The parts of the job that software still can't fully replace. Not every management company earns its money the same way. Some operate on a flat monthly fee per unit instead of a percentage of rent. This model gives the company predictable income regardless of small rent fluctuations, and it gives owners a fee that doesn't quietly grow every time rent goes up. But flat fees also mean the company earns the same amount whether a unit rents for $1,000 or $3,000, which can discourage aggressive rent optimization on the owner's behalf. Owner reporting is a service most tenants never see, but it's central to why owners keep paying. Monthly statements, annual tax documents, and real-time online dashboards all take staff time and software infrastructure to produce. Some companies bundle this into the base management fee. Others charge separately for detailed financial reporting or year-end tax packages. Either way, the owner is really paying for visibility. The ability to see exactly what's happening to their asset without having to ask. Vendor relationships quietly determine how profitable a management company actually is. A firm that manages hundreds of units can negotiate bulk pricing with plumbers, electricians, landscapers, and cleaning crews that an individual owner never could. Some of that savings gets passed to owners as a selling point. Some of it gets captured by the company through markups or preferred vendor arrangements. Either way, the size of the portfolio directly shapes the size of the margin on every repair. Turnover between tenants is one of the most expensive moments in the entire life cycle of a unit, and it's also one of the most profitable for the management company. Cleaning, painting, minor repairs, and relisting all happen in a compressed window, often generating maintenance fees, leasing fees, and inspection fees almost simultaneously. A company that manages turnovers efficiently can turn what feels like a crisis for the owner into one of its most reliable revenue events of the year.